If you're the only one bringing money to the table and you're thinking about buying a home and it feels impossible, I'm gonna show you 5 steps that'll prove that it is not impossible to buy a home. Let's get into the video that's gonna show you how you can buy a home even with one source of income. My name is Sam Sharp. I've been a lender for almost 23 years and I've helped over 10,000 people buy a home. Using my experience, I've been able to help my clients understand better ways to take their money further and to manage their money properly when it comes to buying and selling real estate. And that's my goal with helping you with this channel. The first thing that we want to do is to address a common belief that buying a home on a single income is actually more difficult than 2 incomes combined. And here's the reason why people think that buying on a single income is usually harder. So on the plus side, having a 2 household income is going to allow for dual income, so more money, right, which helps. There's also a position where you have additional credit layering. So when you're in a position where you have 2 borrowers on a loan, you're in a place where that depth of the credit is favorable and that can impact your approval positively. And there's also considering the safety net if you're going through the process and should one of the borrowers lose their job. Well, now you have dual income so you can still qualify. Where people really get stuck on this idea that buying a home is more difficult on a single income is the fact that more money actually means a better approval. The truth is that when it comes to getting approved for a loan, it's basically pass or fail. If you can get approved with dual income or single income, this doesn't necessarily impact the quality of the loan that you're getting. You can have a household where, say, combined, both parties are making $300,000. But what does that look like if one of the borrowers has $150,000 in student loans or high credit card debt? Or maybe you're in a position where besides the debts outweighing the income, you're in a position where the credit is not as strong. Just because you have 2 borrowers on a loan doesn't mean that this is actually going to be better for the loan approval itself. Now, what I mean about everything that I just said, it's not all about how much money you make. It's based off of your financial stability. So when going through the process, lenders are going to look to find out if you're meeting the requirements that lending guidelines have set forward to prove that you have a more higher likelihood of repaying that loan. And this is based off of stability more than the actual amount of income. And some of the things that we look at when we're trying to determine stability will be length and time with the employer. Also, the type of income. It's not just about what you're doing, it's how you get paid. Do you have any type of variables, bonuses, commissions? This is going to be more difficult to calculate or have different guidelines when it comes to financing. We also want to go through and look at the frequency. If you are receiving bonuses or commissions, when do you get this paid? It's not just about what's on that bottom line of the check. It's going to be based off of how you're paid and what that looks like. So I hope this gives you some hope. If you're a single buyer and you're thinking about purchasing a home in the future, in fact, the National Association of Realtors had listed that 29% of the buyers last year were actually single income earners. Now that you're more aware of your ability to purchase a home on a single income, let's dive into the details on what you need to do to better prepare. Step 1, we want to improve our credit score. How does my credit score impact my ability to buy a home? One of the most important parts, actually, it's one of 3 of the most important parts. Your credit score will determine the types of terms that you can qualify for. So this will set your interest rate. This will also determine the amount of money that you can borrow, because if you're in a position where you have lower credit, you may not be able to get an approval with higher qualifying ratios. So in that example, how much money you make will come into play. Overall, your credit score is a reflection of your ability to borrow money and pay that money back. And lenders are looking at what does that history look like. This is why having more depth in your credit is a good thing. So if you have accounts that have been open for 24 months, 36 months, the longer that account has been open and you've shown that you've used that money, you borrow money and then you pay it back, well, this reflects in a positive light. Now fast forward, when you're going to look to buy a home, this shows a higher credit score. That depth in your credit will also go through what lenders use. This is called an automated underwriting system. So there's basically an algorithm that's run through that calculates and analyzes your credit to determine your likelihood of repaying that home loan. So having that deeper credit, higher credit score improves your chances. Let's say if you're on single income and you're in a position now where your 30% of your income is going towards qualifying for this loan. Well, with a lower credit score or shallow credit, let's say, with less credit depth, you may not be able to get that approval. So your credit is definitely one of the most important parts. So in short, the higher the credit score, the lower the interest rate. The lower the interest rate, the better chance you have of qualifying. This also means that you're paying less money to the bank. All right, so what are some ways that you can boost your credit so that you can better prepare for buying a home? So the first thing to look at is credit utilization. And this basically means how much credit do you have available? Key tip here, it's about the percentage of how much credit you have open. So for example, if you have a $100 limit on a credit card that has a $10 balance, that means you have $90 available for credit. That's 90% open credit utilization, right? If you have that set up compared to, say, a $10,000 credit card that has the same percentage, maybe you have 90% utilization, they're viewed exactly the same. And to take that example further, let's say that you have a $5,000 credit limit on your card and your balance on that is $4,000. Well, now you're in a position where you're using the majority of that credit line. You don't have a lot of utilization left. This means that that has a negative impact on your credit score. So when you're looking at controlling your credit score, don't focus on how much you owe. Focus more so on what's the percentage left on that card. If you can get all of your cards down below 30%, okay, 30% is the key number. And this means in that earlier example of a $100 limit, you want to keep that balance on that card at $30 or less. Or if you have a $10,000 limit, make sure that that balance stays below $3,000. This will help you maximize your credit score. Now, I know when you're listening to this, you're probably like, no good. My cards are all above this limit. What am I going to do? You want to start focusing again on that percentage. Pay them down based off of which card you can make the largest impact. Meaning that, again, if you got a $100 credit card and you owe $90 on that, pay that one down first. It's only going to be $80, $90 to pay that down to zero, which is going to have a larger impact. And remember, it's that percentage. Paying that card down versus the $10,000 card will have the same impact. So focus on making your money go further by paying down your accounts across the board, but start with the smaller ones first so you can make the biggest impact. So another way to work on improving your credit, and I know this probably seems obvious, but don't spend all your money. Making large purchases, well, that uses up that credit line. That's going to hurt your credit score. In general, when you're buying a home, if you're serious about buying a home, you shouldn't be making big purchases. Instead, you should be saving your money, right? Saving your money, earning money. So don't make big purchases before you buy a home, not only allowing you to qualify because now you don't have that debt counting against you, but also this puts you in a much better position because you'll have a higher credit score. Speaking of saving money, now that you've ensured that your credit is in good shape, the next step is making sure that you're saving your money effectively so that you're in the best position when it comes time to buy a home. What are you saving your money for in the first place? Well, there's two main expenses that go into buying a home. Your down payment, so this is the amount you're putting down on buying the property, and your closing costs. Outside of your down payment, it's expensive to buy a home. There are a lot of fees that go out there. You're going to need to have money in savings for both of these. When it comes to the closing costs, there's a common misconception that you should use a percentage. Most people say, oh, well, I understand that closing costs are 6% of purchasing the home. That's not necessarily true. And this is where it becomes very important to talk to a mortgage professional. You want to be in a place where you understand your market and how much those costs are in relation to the price. Now, yes, in some markets, on average, you'll pay roughly 2% of the purchase price. However, in many different places, Chicago being one of them, you're in a place where the closing costs for a $400,000 purchase will be very similar to, say, a closing cost on an $800,000 purchase. If you were to use 2% of $400,000, that means you're expecting those costs to be about $8,000. Now that's actually pretty good estimate. You'll be safe on that. However, if you're buying an $800,000 home, your closing costs are not $16,000. They're going to be more expensive because there are transfer stamps, which is an additional closing cost that you have in Chicago, but at the same time, they're not that much more. So you have to be careful about using a percentage. General rule of thumb, if you do use, say, 2 to 3% of your purchase price to account for how much you'll need for closing costs, then you'll be prepared. And I mean, there's nothing wrong with needing less than you have saved. Now that we have the closing costs out of the way, let's focus on the largest part of what you're saving for, and this is the down payment. Down payment is very important. This is going to determine the type of loan that you can qualify for. This is also going to determine what your monthly payments look like. Remember, the more you put down, the less you borrow. The less you borrow, the lower your monthly mortgage payment. So when you're in a position where you're considering your down payment, there can be some advantages to using a larger down payment because you have a lower monthly payment. However, keep in mind, there are actually advantages to a lower down payment. And this isn't just through leveraging your cash and putting your money elsewhere, but also there are certain interest rate adjustments that are more favorable with lower down payment options. So when you're going through and you're looking at buying a home, make sure you consider these options. Talk to your lender. If you're talking to your lender and they don't break down some of these differences for you and why you might want to consider that, then you should probably look at talking to a new lender. You may be assuming that you need 20% down. That's actually not true. Now, if you don't put 20% down, chances are you will incur an additional cost, which is private mortgage insurance, PMI. I'm surprised PMI is not a 4-letter word because so many people dread this. But the reality is that with a high credit score, remember, credit is very important. With a higher credit score, your PMI can actually be very low. And when you go through and you run the calculations and you figure out how much you're putting down versus what impact does that have on your monthly payment. Remember, your monthly payment is one of the most important parts of this. Your interest rate, PMI, all these are just symbols that make up a math problem that ends up in how much are you spending. And that's what we are focused on, right? That's what matters the most at the end of the day of this. So when you're going through and you're using that lower down payment, there can be some advantages where you might be able to then save your money for other things that you need when you buy the home. This is good news, right? I think one of the biggest delays that homeowners are facing right now is trying to save that money for that down payment. Again, if you're buying a $400,000 home, saving $80,000 is not quite that easy. The good news then is that you're in a position where you could put as little as 3% down. And this doesn't mean you need an FHA loan. There are conventional loan options with 3% down that could actually be a better fit. Going up from there, the more you put down, this could improve your terms. But keep in mind, low down payment options can come with better interest rates. They can actually come with lower costs. And you can find yourself in a position where you don't need to wait. The longer you wait to buy the home, the more that price goes up. So when you're in a position where you're considering a low down payment, make sure you talk to a lender and find out, is this the right fit for you? Now that you know what you're saving for, let's talk about how you can save and actually make money while you're waiting to buy. There are several different ways that you can go about making the most out of your savings. First thing that I would recommend, make sure that your money is placed into a high yield account. There are high yielding savings accounts, and this basically means that that savings account is paying you more interest. It's great. I like the sound of that, right? When you're taking out a mortgage, you're the one paying all the interest, right? Well, in this example, we're talking about the opposite of what you're considering, and that's actually being paid on your money, because ultimately the amount you're being paid on your money offsets what you're paying in interest in the future. So make sure when you're saving your money that you have this placed in a high yielding account. So now we're in a place where we have our credit in order, your savings are on track, you've gone through and you're saving the money that you need, you know what to expect. The third step that you want to consider is paying down your debt. This is important. When you're going to qualify for a loan, a lender is going to look at how much are your monthly payments versus your total monthly income. It's not necessarily the balances that you have on a loan. So if you have $50,000 on a car loan, but your monthly payment is only $300, first I want to know where you got that monthly payment from, because that's amazing. But next in line, you want to consider that's what a lender's looking at. So keeping your monthly payments low will actually work better for you when it comes to qualifying for a loan. Because we're going to look at this and say, using this example, if you have $10,000 a month in income that you're making, well, we want to make sure as a rule of thumb that no more than 45% of your income is going towards your total monthly debts. So this means $4,500. That $4,500 then needs to be enough to cover all your monthly payments as well as the new payments for your home. So when you're purchasing your home, you're going to have your principal, interest, taxes, insurance. You could have PMI, or if you're in a flood zone, you might have flood insurance. So keep in mind that $4,500 is what a lender is going to be looking at overall for qualifying for those debts. So bottom line, keeping your debts lower allows you to borrow enough for the type of home that you want as well as the type of loan. If I was to give a suggestion on when and what to pay down, you want to focus on the high interest debts first. They're costing you a lot of money. So pay those accounts down so that way you're not spending more of your money while you're saving. Also though, keep in mind when it comes to credit utilization, when you're focusing on your debts, if you have accounts that are similar interest rates, but you can free up more of that percentage of open credit on that credit card, that's something to consider here as well. If you're looking at your total monthly payments and what you can qualify for, Well, get rid of the high interest debt because it's costing you, but at the same time, also focus on which accounts have the highest monthly payments. You might find yourself in a position where you have an account that has a small balance but has a very high payment, and that could be costing you on your loan approval. Side note, your lender should be giving you this advice. So when you're talking to someone, they should be telling you and instructing you on how to better position yourself. But provided you don't have someone who's in the know, this will give you that information. All right, so for example, let's say that you have one credit card that has a $1,000 limit and you have a $500 balance on that credit card. That is at 6% on your interest rate. Over here, we have a $1,000 limit and you have $500 on this card and it has an 8% interest rate. Well, looking at that, you want to be in a position where you pay off that 8% interest rate higher, because paying this card down is going to have the same impact as the other card. Now let's take that a step further. Let's say you're in a position where you have a credit card that has a $1,000 limit and has a $900 balance, but the interest rate is 2%. It's really nice. I don't want to pay that off, right? Well, keep in mind that could be keeping your credit score lower compared to this card over here that has a $1,000 balance and say a $300 limit on it, but the interest rate is 8%. Yeah, you're spending more in interest on that smaller amount of money, but by freeing up that credit on the other side, that could put you in a position where now your credit score is going to improve. This is the types of strategies that you want to consider when you're buying a home. It's about setting a strategy and a plan. What's the timeline? If you get out in front of this and you have an understanding of the time that you're working with, and working with a good lender, they can help you plan for this. If you're getting that timeline set, you can have a better understanding of, okay, well, maybe I'm paying a little more interest here. However, because this is allowing me to improve my credit score, this now puts me in a position where my borrowing power will be better and my interest rate will be better. I think you'd probably rather pay 8 or 9% on a $200 balance than paying a point higher on your mortgage when you're borrowing $400,000. And this is going to bring us to step number 4. Now, at this point, you already have your finances in order. Your credit's checked out. You have money saving. That money's earning you money. You're in a great position. Maybe you even talk to a lender. But this is where it becomes serious. It's game time. You've got to get your pre-approval, because getting set up with the pre-approval is, well, first of all, you're not able to make an offer on a home without what we call proof of funds. And that's exactly what a pre-approval is. Your pre-approval is showing the seller that if they accept your offer, then come the time of closing, that money will be there. So your approval is incredibly important. And the quality of that approval, I can't stress enough. You want to make sure that when you're making an offer, that the seller feels confident in your pre-approval. When someone's selling a home, they're going to be using an agent. Real estate agent's going to represent them, and then they're going to get several offers. Let's say they get 3 different offers on the table, and they say, this comes from XYZ Mortgage Company, this one comes from ABC Mortgage Company, and this one comes from G. And when they're going through and looking at this, maybe they're all offering the same price. Matter of fact, maybe XYZ is even offering a little bit more. If that listing agent who's selling that property talks to the seller and says, we have 3 offers here,
I think you should go with the original G. Why would you go for the OG on this one? Because we've worked with them before and we know this will make it to the closing table. This pre-approval is solid. Whereas XYZ, I know they're offering you more money. They're never closing. They are terrible at lending.
So when you're going through and you're vetting when to get and who to get pre-approved with, make sure that you take into account the experience and the quality of the people that you're working with, because this is what's going to represent you when you're negotiating on your offer. Well, you're probably wondering then, why? If as we said earlier, it's pass-fail and you're in approval status, then why is XYZ different than the OG or one of the other offers? The reality is that there are different types of approvals. And I want to get rid of this misconception, this myth, or what you might be thinking when you think about, okay, what's a pre-qualification? What's a pre-approval? What's a loan approval? A commitment letter? You're going to hear a lot of terms. So let's break those down real quick so you have a better understanding. The reality is that XYZ is probably doing the pre-qualification. A pre-qualification means that a lender has most likely pulled your credit and they're taking a verbal representation on how much money you make, how much you spend, what your habits are. So you're telling them, this is what I do, I'm in a great position, and based on the math problem they're running, they say you can get a loan. So you're not really getting a professional opinion at that point in time. You're just getting someone who can read back to you and say, like, okay, well, yes, if you have 2 and 2, that does equal 4. that doesn't work so well. Remember, you're working with a professional because they know how to help you look out for these pitfalls. So in this example, XYZ, if they're not actually taking the time to verify your information, there's a good chance that something's missing. What could be missing? I don't know, maybe you're in a position where your income, you have a new job. Matter of fact, you don't just have a new job, you've got a new business, and it's a really successful business. You are killing it. But guess what? You've only had that business for 2 months. Now the problem is that, according to most lending guidelines, you can't borrow money. XYZ didn't take the time to verify this, and now your loan doesn't close. So pre-qualification is dangerous. Just be careful. They're easy to get. Go online, you can get this. You can usually get it from anyone. They probably will be called XYZ. So just make sure that if it's too easy, something might be wrong. And that brings us to the pre-approval. Now, a pre-approval means that a lender will have reviewed your credit, they'll have reviewed your income and your assets. So now they've determined 2 + 2 is 4. They've determined and had that conversation with you about your business. And if you just started a business, on the timeline that you'll have to wait. Are you going to have to wait a year? Do you have to wait 2 years? Are there any other loan programs that you might be able to qualify? The underlying theme here is that it's a more thorough review of all your income and your documents to make sure that you can qualify for the loan. Do yourself a favor. Don't make this too easy. I know that it can be a pain, but keep in mind, you're going to have to do this at one point in time or another, no matter what. It's better to have everything done up front. You cannot be too proactive when preparing for your financing. So get everything on the table now. And this is one of the reasons why the pre-approval is so important, because you want to find out exactly what you're working with. Not only does this help you provide a stronger approval to the seller, but now you know how this impacts your budget, because there's something in that approval that could impact your interest rate. Maybe you talk to the lender and there's something in your credit that's a problem that they can help guide you on fixing, and now you can get a better interest rate. See the theme here? Better interest rate, cheaper money. So we're looking for that. I mentioned also looking at what's a commitment letter or a loan approval. These two really should be the same thing. And basically what this means is that not only have you supplied all your income, all your bank statements, all your documentation that a lender could request, but then that's been reviewed by an underwriter. Now, this is something I believe in very strongly. I've been practicing this with my team for over a decade. We go through and we take a look at everything up front. And this is something you want to do. Go through and use the time while you have it. It can be stressful to buy a home. And one of the important parts of a pre-approval that I think people don't focus on, this actually puts you in a place where it's going to be a much smoother process. Now, once you go under contract, you can focus on the other moving parts that could otherwise seem stressful. So to wrap this around and to get a better idea, think of a pre-qualify as easy, maybe I can get this done, versus a pre-approval. A pre-approval is going to have a qualified lender's experience and stamp of approval. It's basically showing the seller on that side that someone who knows what they're doing is guaranteeing that you're going to get that money. By the way, if you are thinking about buying a home in the next 90 days, check out this video where I will break down step by step everything you need to know on how to make this a reality in less than 20 minutes. And this brings us to the final step, number 5, and I think one of the more important parts, and that's going to be talking about the loan programs. And this isn't going to be an incredibly long video, but I want to give you some details. Otherwise, if you want more information on loan programs, check out my other video. When I talk with clients, the first thing we figure out is how much we can borrow and what that looks like. But then going through, we want to talk about what type of loans. What's the cheapest way for you to get that money? We might want to talk about, well, government-backed loans. This is where you'll hear terms like an FHA loan. An FHA loan is a government-insured loan. The benefit there is that you can get a lower interest rate with a lower down payment and find yourself in a position where you may be able to qualify for a lower monthly payment. There's also, within that government umbrella, will be VA loans. This is one of the best loan programs available. More flexible guidelines, as little as no money down, much better interest rates, no mortgage insurance. There's a long list of why the VA loan is absolutely the best loan product out there. You're also going to be looking at portfolio products, and these have become more important and more popular moving forward. And this is where you can find alternative lending sources for, say, your self-employed individual, where, well, what's good for the tax man's not so good for your banker, and maybe the way that you set up your taxes shows less income. Well, this can allow for an option where you can use, say, a bank statement loan, and we can use your bank statements to qualify your income. Or maybe we use what's called a DSCR loan. Thank you, commercial lending world. This is where we qualify based off of the property itself rather than just your income. So these portfolio products can be a great alternative to qualifying for more loans. Consider just even within the conventional loans, and this is where you're dealing with, maybe heard of Fannie Mae and Freddie Mac. This is more vanilla out of the box financing. However, under the vanilla financing, portfolio products, government loans, there can be additional down payment assistance programs that fall into all of these categories. So when we're talking with our clients, we're going to figure out, okay, what's the best loan product for you? What's going to allow you to borrow the money so that you're going to pay the lowest monthly payment, not necessarily just the lowest interest rate. Because if there's a position where, for example, let's say you have a lower interest rate, but you're putting less down and your mortgage insurance is higher. Well, that might make more sense to use a slightly higher rate where you're in a position where you have no mortgage insurance. We'll compare that to, well, what if your interest rate is lower, but your closing costs are higher? This is a very popular option right now. We're in a high interest rate environment at the time of recording this video. So lenders are turning towards advertising low interest rates, but then they come with very high costs. So when we're going through and looking at the types of loan options we want to consider, okay, well, what's the interest rate and what is it costing you? Remember, these are symbols. I believe very strongly in this. These are just symbols that represent what you're considering and how to compare options. Ultimately, we're dealing with money, and you need to have a better understanding of, okay, how are you going to make sure at the end of the day, one of these loan programs and buying a home is going to put you in a place where you keep more of your money in your savings, and then you keep more of your money as you move forward, and you have to pay for that payment every month. What this means, hearing all of this, if you're a single income earner, first-time home buyer perhaps, this means that the type of loan that you take out could be very important. A government loan could be an option that you want to consider, but there also may be better options with conventional financing. A common misconception is that government loans are your only low down payment option, and the reality is these loans could be more expensive than your conventional options. Both of those may be more expensive than the portfolio option. But outside of all this means there's hope. This means there's a great option available for you to find a lower down payment if that's what you need, as well as loan options that ultimately will allow you to spend less money and to have a much lower monthly payment. So it's more important than ever to talk to the right lender to find out which option, comparing multiple options, is going to be best for you and how you're going to be able to accomplish what you're looking to do. Let me give you a really good example on why I don't like these cookie cutter options and why it's really important to talk to a lender who's considering everything that might work for you. A client comes to me the other day and says, I need an FHA loan. What type of rates do you have on FHA? I had to ask some questions like, well, first, why? Why do you want an FHA loan? Their explanation was, well, I'm putting 3.5% down. I want a low down payment, so I need an FHA loan. That wasn't true. So the next question, how was your credit? Remember, credit is very important. So how's your credit? I said, oh, I have excellent credit. My credit's amazing. I said, okay, are you buying a multi-unit? And they said, no, I'm looking at a single family home. Like, okay, well, I don't understand why you're using an FHA loan, because a conventional loan will allow as little as 3% down. Unfortunately, on the FHA side now, I love FHA loans, okay? We do a lot of these, and for the right situation, again, when we're talking to a client and it's the perfect fit, this could be a great loan program. But you have to keep in mind there's expenses, and one of the biggest expenses when it comes to FHA, there's an upfront mortgage insurance premium, not just your monthly mortgage insurance premium. So you have an upfront mortgage insurance premium that strips almost 2% of your equity out of the gate. So conventional financing doesn't have that option. When you're comparing lenders, in this scenario, the client was, the FHA loan had a lower interest rate, but the conventional loan, overall, the monthly payment was about the same because the private mortgage insurance was less on the conventional loan than the FHA loan. Going back to that, how much you actually spending piece, this is where it became incredibly important to look at the right loan program. That client was going to be giving up almost $9,000 of their equity out of the gate to use that FHA loan for a monthly payment that was like $11 different. So save $11 or to pay $9,000, or go over towards a conventional loan, which had a much better option of also eliminating the PMI in the future. This will give you an idea of why you don't want to just take what's put in front of you out of the box. You want to talk to a lender who's going to give you multiple options and explain why that's a good option versus some of the other options that you may have or haven't heard of. All right, that's a lot. Congratulations on making it this far. If you're a single income earner, hopefully you are feeling a lot better about the process, because right now you're going back, you're watching this video again, and you're following the 5 steps. You're working on your credit to to make sure that you have the best possible credit score. You're saving your money and making sure that you're making the most out of your savings. Paying down your debt. This is going to become very important when it comes time to qualify. Speaking of qualify, you're going through, you're getting pre-approved or getting a loan approval in place, and then you're moving forward. Last step, and looking at the types of loan programs that can help bring all 5 of those together. Remember though, none of this works unless you're working with the right lender. And I'm not just saying this because I think I'm the right lender, even though I am. And of course, if you want to speak with me, please make sure you click below to schedule a call. Don't do this on your own. Coming from someone who's made a career of 23 years, I've got to tell you, it's a lot. There's a lot that goes into this. And using that experience is something that's going to help you avoid some of the mistakes that you might make otherwise. You don't want to take this on by yourself. So even if you don't book a call below, make sure you talk to someone reputable, someone that you trust, and that you get someone on your side. Other than that, I'll see you in the next video, and maybe check out one of my other videos that'll help you buy a home.